You've probably heard the term ETF thrown around a lot, right? Especially when we're talking about US stocks. But what are they, really? And why are they so popular? Well, in this explainer, we're going to cut through all that jargon. We'll break down exactly how US equity ETFs work and how they might fit into a modern investment portfolio. Okay, so here's what we're going to cover. First, we'll hit the fundamentals, what an ETF even is. Then, we'll jump into the big showdown, active versus passive management. After that, we'll see how you can use different ETFs for building a portfolio. And finally, we'll wrap up with how to do your own research and, of course, the important disclosures. Sound good? Let's dive in. Okay, let's kick things off with Section 1. Before we can talk strategy, we've got to get the basics down. So, the big question, what exactly is an exchange-traded fund?
So, you know how a fund is basically a big pool of money from a bunch of investors, right? And it's all managed by some institution for a specific goal. Well, an ETF, that's an exchange-traded fund, takes that whole idea and makes it super easy to trade. You can buy and sell shares of an ETF on a stock exchange throughout the day, just like you would with a single stock, like Apple or Google.
I bet you've seen some of these tickers before. SPY, for example, is a huge one. It tracks the S&P 500. Then there's QQQ, which follows the NASDAQ 100, so it's very tech-focused. These, along with others like DIA, XLF, and even RKK, are all super popular ETFs that let you buy a piece of a specific market with just a single trade.
And this is where ETFs get really powerful. They're not just for stocks. I mean, sure, equity ETFs that track indexes like the S&P 500 are definitely the most common type, but you can literally find an ETF for almost any asset class out there. You've got fixed income ETFs for the bond market, commodity ETFs for things like gold or oil, currency ETFs, and even what they call alternative ETFs, which track more complex stuff, like market volatility using VIX futures.
All right, so we know what ETFs are. Now let's get into a really important concept in the world of funds. It's this big debate, really, between two competing philosophies, active versus passive management.
So what's the difference? It really all boils down to strategy. A passive ETF, think of it like it's on autopilot. Its only job is to replicate a market index, like the S&P 500. That's it. So its performance is going to be tied directly to that index. But an active ETF, well, that's different. There's a human manager, or a team, in the driver's seat actively picking stocks, deciding how much to buy and when to sell, all in an attempt to beat the market. With an active fund, your success is really riding on that manager's skill.
And that difference in strategy has a huge impact on one thing every investor cares about: cost. Passive ETFs are mostly automated, so their management fees are usually super low. Active ETFs, on the other hand, have a whole management team making calls, so naturally they charge higher fees for that service. And just a quick note, broker commissions, the cost to actually buy and sell the ETF, that applies to both types, no matter which one you pick.
Okay, so the million-dollar question, which one is better? Well, if you look at the data, a pretty clear trend emerges. And this quote from the source really sums it up. The longer the evaluation period, the lower the win rate for active ETFs.
So what does that mean for you? Well, for anyone investing for the long term, we're talking 5 years or more, like for retirement, the data suggests that passive index ETFs have a higher probability of delivering better results. And a big reason for that is simple. Those lower fees just don't eat away at your returns as much over a long period of time.
Okay, so we've covered the what and the how. Now let's get into the really practical stuff. We're going to look at how investors actually use different kinds of ETFs to build out their portfolios and meet different financial goals.
Let's start with dividend ETFs. The whole point of these funds is to screen for and invest in companies that not only pay high dividends, but are also financially strong. The goal here is pretty straightforward: generate a stable stream of income. And a nice side benefit is that these types of stocks tend to have lower price volatility, which can help bring down the overall risk of your portfolio.
And if that income strategy sounds interesting to you, there are some pretty mainstream options out there. The source mentions VIG, which is one of the biggest ones. It focuses on large U.S. companies that have paid dividends for at least 10 years straight. FDRR, OUSM, and EOUDV are a few other examples in this space.
Okay, next up, bond ETFs. For most of us, buying big institutional bonds directly just isn't really an option. So, bond ETFs are the solution. They give individual investors like you and me indirect access to the fixed income market. And just like individual bonds, they can generate steady income and, importantly, act as a hedge when your stock portfolio is going through a rough patch.
A classic example here is the ETF with the ticker AGG.
This fund is designed to give you broad exposure to the entire U.S. bond market. We're talking government treasuries, corporate bonds, you name it. It's a really common building block for that classic 60-40 stock and bond portfolio.
All right, let's switch gears and talk about commodity ETFs. These funds track the prices of physical stuff, things like energy, metals, and agricultural goods. So why would you want one? Well, their biggest strategic benefit is that they can be a really effective hedge against inflation. Think about it. When the value of the US dollar goes down, the price of commodities often goes up. A good example of a diversified commodity fund is PDBC. It doesn't just track one thing. It actually tracks 14 different commodity futures. So you get broad exposure to the whole asset class, with its biggest positions being in things like crude oil and gold. So you want to invest around the world. Emerging market ETFs are basically your ticket. They give you exposure to stocks in rapidly growing economies, countries like China, Brazil, and India. And the best part is the simplicity. You can get that global allocation without the massive headache of trying to open brokerage accounts in a bunch of different countries. A very popular one in this space is VWO, which tracks the FTSE Emerging Markets Index. Now, this kind of ETF is really for investors who think on a global scale. They're looking at the big picture and making a strategic bet that these emerging markets have a stronger growth potential than more developed economies. Okay, we've covered a lot of ground. You've got the basics down, so for our last section, we're going to touch on two really critical topics: how you can do your own research and some final disclosures that you absolutely need to be aware of.
So how do you dig deeper on your own? Well, a great place to start is the public websites of the big asset managers. They provide info on over 80% of mainstream ETFs, and they'll tell you right away if a fund is active or passive. Another pro tip: always check the fund's holdings. Looking at what it actually owns is the best way to understand its exposures. And the source also suggests this: once you find a fund you're interested in, cross-check it on your own brokerage platform to really get a full picture.
And to wrap up, we have to end with a really important reminder. This explainer is just for informational purposes. It is not investment advice. Every single investment carries risk, and that includes the possible loss of the money you put in. So you have to make your own decisions based on your own research and your personal financial situation. And never, ever forget the golden rule of investing, which you see right here: past performance and historical analysis are not indicative of future results.